All right, let's jump right into it. If you spent more than 5 minutes online recently, you've probably been absolutely bombarded with ads for automated trading algorithms, right? They all promise to be this holy grail of effortless, passive income. But we're here to cut through the noise and unpack the actual reality behind all that flashy marketing in this explainer.
Because with every influencer pushing some new, supposedly foolproof platform, we really have to ask the ultimate question. Can an AI actually print money while you sleep? We're going to look at the hard data, some incredible open source tools, and, most importantly, the hidden traps that completely wipe out almost every beginner.
Okay, just so we're all on exactly the same page, an automated trading system, or ATS, is simply a computer program that fires off trades at speeds and frequencies that humans literally can't match. Now, the old versions used really rigid rules, but modern systems, they're increasingly relying on AI reasoning to crunch massive amounts of data and actually pull the trigger on trades.
Here is the roadmap for this explainer. 1. The automated trading dream. 2. From algos to AI agents. 3. The modern retail toolkit. 4. The backtest illusion. And 5. Hidden costs and fees. Starting with Section 1, the automated trading dream and the allure of automation.
You see pitches from platforms like AutoCoin all the time, and they highlight this absolute ideal scenario. It's the dream of a machine that trades 24/7, no sleep required, completely removing messy human emotions from the equation. You're promised institutional-grade speed and these wild back-tested promises like turning 10 grand into over $4.4 million through crypto momentum strategies. The whole idea is just hands-off, consistent compounding.
Which brings us to Section 2, from algos to AI agents and the evolution of ATS.
Believe it or not, this didn't just pop up overnight in Silicon Valley. We've actually leaped all the way from Richard Donshin doing manual rule-based charting back in 1949 to those lightning-fast algorithms that triggered the infamous 2010 flash crash. And now, in 2026, we have large language models acting as actual reasoning engines. Rather than just crunching raw numbers, these AIs are literally reading earnings reports and reasoning through market news in plain English. When you peek under the hood of modern open-source frameworks like trading agents, it is honestly mind-blowing. It's no longer just a single line of code making a wild guess. It's a whole virtual firm. You've got a fundamental agent analyzing the ratios, a sentiment agent reading the social media mode, and then, get this, a bull and bear agent formally debate the findings. Finally, a risk manager agent has to stamp its approval. It's a highly structured debate happening entirely inside the machine before a single dime is risked.
All right, Section 3, the modern retail toolkit and your trading options.
So what do your actual options look like today? You basically have 3 paths. First up are paid retail platforms like AutoCoin. They give you pre-built bots for a flat monthly fee of around $149, completely hands-off via a read-only API. Second, there are integrated AI assistants like TradingView Remix that sit right on your charts to optimize your manual setups. And third, you have heavy-duty open-source frameworks like FinRL or AI Hedge Fund. Those use complex reinforcement learning and even mimic legendary investor personas. But yeah, they require some serious technical chops to set up. Take TradingView Remix, for example. It acts like an incredibly smart companion. It can scan the entire market for breakouts, instantly spot bottoming formations, and then run thousands of parameter combinations to optimize your strategy. Basically, it does all the grueling manual backtesting for you so you can immediately see what offers the best risk-adjusted returns across any major asset. But, and this is a massive but, you really need to listen to algorithmic trader Michael Automates here. He explicitly warns against blindly trusting black box systems where you can't actually see the logic. You absolutely need a transparent backtest to understand the core strategy. Why? Well, because when that bot inevitably hits a losing streak, you're going to need the psychological conviction to survive the drawdown instead of just panicking and shutting the whole thing off at the absolute worst possible time. Which leads us to Section 4, the backtest illusion, simulated versus live. This is arguably the single most dangerous trap in automated finance. The massive, glaring gap between a beautiful simulation and the brutal reality of the live market. A backtest naturally assumes perfect conditions, zero slippage, flawless order fills, absolutely zero API latency. But live trading? It's messy. You're dealing with widening bid-ask spreads, surprise funding fees, partial fills. That paper strategy showing a 50% annual return can effortlessly tank to just 10% or go totally negative the second it hits the friction of the real world. To put that into perspective,
Let's look at a real, documented live run using the super sophisticated trading agents framework. Over 30 days, it managed a 7% return. Now that sounds pretty great compared to the S&P 500's 4.5% over the same stretch, right? But here's the catch. Securing that 7% meant enduring a totally brutal 22% drawdown along the way. Even top-tier multi-agent setups experience massive volatility that frankly most retail traders just cannot stomach.
And that brings us to Section 5, Hidden Costs and Fees, the Silent Killers.
Let's talk about where your capital actually vanishes. Most people only look at the headline broker commission, but a live bot is paying a heavy, multi-layered stack of fees. Sure, you have maker/taker fees, but you also have slippage. You have funding rates in futures markets settling 3 times a day. Plus, if you're using advanced AI, those LLM API costs can run up to 50 cents just to analyze one single ticker. Throw in your monthly platform subscription, and your money is quietly draining away before you've booked a single profit.
Slippage is a huge culprit here. It's basically the difference between the price you expect to get and the price you actually get filled at. While over 97% of market open orders get filled at the quoted price, the open is incredibly volatile. If your bot is constantly firing off fast market orders into a volatile open, losing just a tiny fraction of a percent on every trade will violently compound into a massive, massive loss over time.
Let's break down the math on how violently this compounds with a terrifying example from the exchange WeX. Say you're using 20x leverage on a $5,000 margin. That makes a $100,000 position. A simple taker round-trip trade costs 0.16% on that total position, which comes out to $160. Think about that. A staggering 3.2% of your actual margin is just completely wiped out in fees before the asset even moves one single tick. Do that 20 times a day, and boom, you've lost over 60% of your account just paying the broker.
It's exactly because of these harsh mathematical realities that regulators like the CFTC explicitly warn people about this. Any bot promising you guaranteed massive returns or claiming a 100% win rate is straight up fraudulent. While legitimate open source frameworks are very transparent about the risks, the internet at large is completely flooded with scams that conveniently ignore all the math we just went through. So, wrapping this all up, what's the big takeaway from this explainer? AI trading frameworks are unbelievably powerful for research, backtesting, and execution, but they are absolutely not magic money printers. You have to always paper trade before risking your real capital. You must relentlessly account for every hidden fee, the slippage, and those API costs. And most importantly, deeply understand your bot's strategy so you don't hit the panic button when the machine inevitably goes through a rough patch.
So, before you hand over your hard-earned cash to an algorithm, ask yourself, do you actually have the discipline to supervise the machine, or are you just setting yourself up to let hidden costs silently drain your account while you sleep? It's a game-changing toolkit for sure, but only if you're willing to be the manager, not just a bystander. Thanks so much for joining me on this explainer, and I'll